Understanding lagging indicators, their role and implications. What is a lagging indicator? A lagging indicator is a measurable factor that changes after an economic, financial, or business variable has already changed. These indicators help confirm long-term trends and shifts that have already occurred, rather than predicting future movements. For instance, they can be instrumental in evaluating the overall performance of the economy, guiding business strategies, or making trading decisions in financial markets. Key takeaways. Lagging indicators shift only after correlated economic variables change. Common examples include unemployment rates, corporate profits, and the costs of labor per unit of output. Lagging technical indicators serve to confirm price action rather than predict movements. Importance of lagging indicators. Lagging indicators serve several critical functions across various sectors. Economic insights. Lagging indicators are vital for confirming whether significant economic changes have occurred. They reflect data that is often subject to revisions and can help analysts avoid misleading short-term fluctuations witnessed in leading indicators. Business metrics. Businesses utilize lagging indicators to assess the impact of previous management decisions or strategic changes. These indicators often leverage historical data to evaluate performance metrics, such as sales revenue or customer satisfaction, making them useful for retrospective analyses. Financial market signals. In financial markets, lagging indicators can signal potential buy or sell opportunities. Technical traders often engage with these indicators to confirm strength or weakness in prevailing trends, enhancing decision-making based on past price action. Types of lagging indicators. Economic lagging indicators. The U.S. Conference Board publishes a monthly index of lagging indicators, which includes economic metrics like average duration of unemployment, measures how long individuals are unemployed before finding new jobs. Average prime rate, reflects average interest rates charged by banks on loans. Change in the Consumer Price Index for services, tracks price changes in goods and services consumed by households. Other notable economic lagging indicators include Gross Domestic Product, GDP, the Consumer Price Index, CPI, and the Balance of Trade, BOT. Business lagging indicators. In a business context, lagging indicators are types of key performance indicators, KPIs, that measure organizational performance after changes have occurred. Examples encompass sales figures, customer churn rates, revenue growth. These indicators help businesses relate past performance to strategic decisions and operational changes. By analyzing these metrics, companies can identify strengths and weaknesses in their operations. Technical lagging indicators. Technical indicators often used by traders fall into the category of lagging indicators due to their retrospective nature. A prevalent example is the Moving Average Convergence Divergence, MACD, which calculates the relationship between two moving averages of an asset's price. Although powerful in confirming momentum, technical indicators may result in delayed entry points for trades since they react to moves that have already occurred. Lagging versus leading indicators. The distinction between leading and lagging indicators is crucial for analysts and traders. Leading indicators, like retail sales and stock prices, forecast future economic changes and trends. Lagging indicators, on the other hand, assess past trends and their impacts. Practical applications of lagging indicators. Lagging indicators play a significant role in various fields, including economics, business, and finance. By understanding these indicators, stakeholders can make more informed decisions based on confirmed data, which provides insights into long-term growth or declines. For instance, economists might use lagging indicators to discuss the effectiveness of monetary policies by analyzing the unemployment rate or inflation. Businesses will evaluate lagging indicators to determine the impact of a marketing campaign after it concludes, allowing for data-driven adjustments in future initiatives. Investors often rely on lagging indicators to confirm trends before making significant investment decisions, thus minimizing the risk associated with premature trading based on volatile leading indicators. Conclusion: lagging indicators are essential tools for anyone engaged in economic analysis, business management, or financial trading. By reflecting changes that have already occurred, they confirm trends and provide insights into past performance. Understanding both lagging and leading indicators enables more holistic decision-making and strategic planning in various contexts. Whether assessing economic health, evaluating business outcomes, or informing investment strategies, lagging indicators remain a cornerstone of informed analysis.